Hey, this is Big G or Gene or Gino or Dad or however you know me. This is lesson number 9. We're going to be talking about time frames as you're looking at stock charts. But before we go into that lesson, I want to talk to you about the difference between a stock and an ETF. This is a chart of, they call it the SPY, or the spider, some people call it. It's an ETF. The S&P 500 is the top 500 stocks in the stock market. You hear about the Dow Jones. The Dow also has an ETF. The NASDAQ has an ETF. And what is an ETF, or an exchange traded fund? Well, if you know what a mutual fund is, it would help you to understand better what an exchange traded fund is. What's a mutual fund? Well, if you have a retirement account, some kind of annuity, 401k, IRA, you probably have money in a mutual fund or several mutual funds. And mutual funds are a basket of stocks, maybe dozens or maybe even hundreds of stocks in this fund. And it's just a basket of stocks all together in this one fund called a mutual fund. And a lot of times mutual funds are based on a common denominator, maybe as tech stocks or Dow stocks or energy stocks or bonds or whatever. So there's all kind of different types of mutual funds. And the price of a mutual fund only changes once a day after the market closes at night. An exchange traded fund is similar to a mutual fund, except it trades like a stock. Its price changes every day. The SPY is a popular ETF to trade because it's highly traded. You see today was 160 million trades made, the volume. And so the SPY is also a good barometer of how the market is doing. And so you can watch the SPY and it tells you how the market is doing. We go to the Dow Jones is the DIA, they call it the diamonds. And this is the Dow Jones Industrial Average ETF. And you see the charts are very similar. You go to the Qs, QQQ is the NASDAQ. It follows the NASDAQ. And then some ETFs follow specific sectors, like XLF is the ETF for the financial sector. You got XLU for the utility sector. You've got XLE for the energy sector, and so on. So a lot of people just trade ETFs because they don't always act quite as volatile as a stock might. Now, you're looking at this chart and you're saying, dude, that looks pretty volatile, and you're right. And this is February the 16th. And so the past couple of weeks this year, we've had this correction going on. And you see, so far, it's like it's kind of bottomed out down here, and it's kind of popping up again. But that's an ETF. And for the rest of the conversation, let's go back to the SPY, the spiders, and let's talk about time frames and charts. Now, what you see in most of the charts that I've been showing you, and most swing traders, day traders, they start with the daily chart. So this is the daily chart. I see it up here, daily chart of the SPY. And you remember from previous lessons, I put the 9 and the 20 EMAs in here. The 9 is the 9 exponential moving average. It's the average price over the last 9 days. And the 20, the red line, is the 20-day exponential moving average. And that's the average price for the past 20 days. So what I wanted to show you is, you may not be as interested as I am in this. Maybe you're interested in it, but you just don't have the time to invest in it. Maybe you just want to look at charts once a week, maybe once a month. Maybe you want to do it every day. You want to be a day trader and trade throughout the day. What I want to show you is, as you continue to learn chart patterns and candlestick patterns, which we'll be talking about more in upcoming videos, they all work. The candles and the chart patterns, everything, all these indicators, we're going to talk about these different indicators in the future. All of this works in any time frame. So for example, you remember when we talked about the little 920 crossover? I showed you how to do that in I think one of the first videos. And so here's the SPY daily. You could buy here at this crossover. Here, you could buy here. This goes all the way back to September. you would hang on to it. You'd probably get out right here when it crosses below the red line, the 20, then maybe you hop back in up here somewhere. And this is just watching a daily chart and just saying, okay, I'm going to hold on to it. And when it bumps or goes over over down below the red line, the 20, I'm going to get out. So you could have conceivably bought here and made money, here and made money. This would be a jump in here, make some good money just by watching the daily charts and that 920 crossover. Now, let's say you don't want to watch the daily charts. Let's say that you just want to keep an eye on it maybe every week or so. You can go to a weekly chart. And this is the weekly chart of the spiders. And you see this goes from today, February the 16th, 2018, all the way back to 2014. So let's just say you're watching the weekly chart, and you can still hop in right there at this week. Each candle represents a week on this chart. So you get out here, so you made a little bit of money there. Not a whole lot going on this kind of flat on this particular chart. Here's a good place. Get in here, you get out here when it bumps, maybe get back in up here, kind of flat lines here a little bit, get back in here, and then you can ride this up. Look, this is right after the election, November of 16. This is the Trump rally, and so ever since Trump got elected in November of 16, you'd be in, and you would ride it all the way, all the way, all the way till 2 weeks ago. And that's just doing a weekly chart. Well, let's say you don't even want to do a weekly, you don't have time for that. You can go to monthly, and you can watch the monthly charts. And again, this goes back to 2003, way back here. So you can just buy the crossovers on a monthly. You could go short here. This is 2008. 2008 was a classic downfall of the market, and you could go short on that crossover. You could come back in here, get out here, back in, and ride it all the way up to here. So you see what I'm doing, I guess, is all these different time frames, and you see them on stockcharts.com. It starts with you can go as far back as monthly, weekly, daily, and then you can even go to 1 minute charts. Now I don't go to 1 minute, but I do look at 5 minute charts. And so let's look at today's 5 minute chart real quick. This is for day traders. If you're day trading, these are called intraday charts. Intraday charts are charts, obviously happening inside that day that are anywhere from, in this case, 1 minute to 2 hour charts. So here's a 5 minute chart of the SPYs today, February the 16th. Starts right here. It shows you 2 days. This is the end of Wednesday, and then this is Thursday, February the 15th, and then here. So just in this case, yesterday, if you're doing the crossover, you come in right here. Maybe you have your stop right here. You could, where are we at? Maybe here. It's not really a crossover, but you see that big bump going up there, and then you might get out here. And if you wanted to, maybe go short with the put option down here, and probably wouldn't make much, kind of some garbage time in there. But my point is, whatever time frame you're trading, you can use your same strategies. Now, I've just been using this 920 strategy just to show you and give you some examples because it's easy to understand. But to be honest with you, I don't use the 920 crossover that much. The more I look at it, though, doing these videos, I'm thinking, man, maybe I should be doing the 920 crossover. I have other strategies that I use, but I'm just showing you this mainly so you can see how you can work within time frames. Here's the 30-minute. I wanted to show you the 30-minute chart too. Maybe you're holding something for a day or two or three. You can use a 30-minute chart. And so right here, you may go short with some put options. We'll talk about options further down the line, but put options help you to make money when the stock is going down, or the ETF in this case. So this is a 30-minute chart going back to into January, and you could buy at the crossover here. That would have been on, let's see, we would go short here on February the 1st, right at the end of the day. And you could run that thing down all the way till probably right around here, get out of it on February the 6th. So that's a nice little run. You might pop in here, but you're not going to get a whole lot. It's going to fool you. And here you come back down. You can go to short again down here with a put option and ride that baby all the way down to this area and get out. And then, of course, you get in here, and you're probably going to might get out here when it's touching the 20. Another place to get out here, but then maybe you're in up here and ride it out. So hopefully you'd see that my point is, no matter the time frame, whether it's monthly, weekly, daily, or intraday, there's a way to play these charts. The candlestick patterns all work regardless of time frame. The moving average strategies that we'll be talking more about, like the 920 crossover, all of these things work no matter the time frame. So just something you need to know, and hopefully you learned a little bit of something, and we'll see you next time at lesson 10.